Okay, hi everyone. Today we are going to start a new chapter, chapter 11, accounting for current liabilities. Of course, you know that my liabilities is my debts towards other, my obligations, and it's classified into current and non-current liabilities. The difference between them that the current liabilities are my debts or obligations towards or within a short term. I'm going to repay them within a short term, maximum 1 year. However, the non-current liabilities are the long-term liabilities. I'm going to repay them within more than 1 year. Types for current liabilities are things like, for example, accounts payable, when I buy any product on credit, or I receive any service on credit, which means that I do not pay for it now, but I will pay in the future. However, I got the benefit. Also, there is example for current liability, wages payable or salaries payable, since for sure I will be obliged to pay the salaries for my employees or the wages maximum within 1 month. It is a short term, not a long term one. Also, interest payable, all of these are considered as current liabilities. Another example for current liabilities is the notes payable. Notes payable is like the bank loan, when I take a loan from the bank. Some of the cases the loan may be within a short term, so notes payable can be classified either current liability when it's short-term notes payable, or non-current liability when it's a long-term notes payable. It's paid within more than 1 year, for example, so it's classified as non-current liability. Let's focus today on the current liabilities. We'll start with solving an exercise accounting for sales tax before focusing on the short-term notes payable. Okay, exercise 1, Dextra computing sells merchandise for $6,000 cash on September 30th. Cost of merchandise is $3,900. The sales tax law requires Dextra to collect 5% sales tax on every dollar of merchandise sold. Again, as we have repeated so many times, why do I have these two numbers, the 6,000 and 3,900? Because I will record an entry or I make an entry for recording the revenue, the sales, and another entry for recording the COGS, the cost of goods sold. Okay, this is so that what is required from me: number 1, to record the entry for the $6,000 sale and its applicable sales tax. Then number 2, to record the entry that shows the payment of the 5% tax on this sale to the state government on October 15th. Let's start with the first one, to record the sale of 6,000 with its applicable sales tax. It said that the Dextra will pay, or the government will collect, the sales tax law requires from Dextra to collect 5% sales tax. Okay, so the entry will be as follows. First, debit cash, credit sales, and credit sales tax payable. The sales that happened is with 6,000, so credit sales with the 6,000. What about the sales tax payable? The sales tax payable, I am obliged, or I have a debt toward the government to pay the sales tax. However, I'm not going to pay it now. That's why it's called sales tax payable. As we have agreed that anything that is payable is considered as a liability. So credit sales tax payable, considered a current liability, with 300. From where did I get this 300? I just multiply the 5% the government determined for me times the 6,000 sales. Gives me 300. So the debit cash with 6,300. The cash that I received is with 6,300. Okay. The another entry that I need to record the cost of goods sold. Debit cost of goods sold on September 30th as well, and credit merchandise inventory with 3,900. This is the cost. Okay, what about the second requirement? I need to record the payment of the sales tax, so I'm going to say debit sales tax payable and credit cash, because I'm paying the sales tax to the government here. Okay, moving to exercise 2, to solve on the notes payable. Exercise 2, accounting for notes payable. Sylvester Systems borrows $110,000 cash on May 15, 2017 by signing a 60-day 12% note. So here the amount of the loan or of the note is $100,000, and the date on which this amount is borrowed is the 15th May 2017. For how much? For how many days? For 60 days. So the maturity date will be after 60 days from that day, the 15th of May. And the interest rate is 12%. So number one, on what date does this note mature? Actually, since it's stated that the amount of this note is 60 days, so I'm going to just add on the 15th of May another 60 days. The maturity date will be May 15 plus 60 days, so it will be July 14, 2017. What about the second requirement? Suppose the face value of the note equals $110,000, the principal of the loan. This is the amount of the loan. Prepare the journal interest to number one, to record the issuance of the note. B, to record the payment of the note at maturity. Let's start with the issuance of the note. Okay, let's start with the first transaction, which want to make an entry to record the issuance of the note. So it's going to be debit cash credit notes payable. What I mean by issuance of the note, on the day I borrow the money, the bank issue for me a certain note in which I sign on it that I'm obliged to pay this amount of money to the bank, this amount of loan. So that's why we say issuing a note. The issuer is the bank or the other party, and I'm the one who borrow the money. So debit the cash, my cash increased because I'm borrowing money, and credit notes payable because I have liability or obligation toward the other party or the bank. The second entry I want to record is payment of the loan along with the interest on the maturity date, which is July 14th. So debit interest expense because I've got the benefit from borrowing this loan. For example, I've just make a project with this loan or whatsoever. So I debit the interest expense, and debit notes payable because now I am no longer obliged or having liability toward the bank or the party I borrowed from. So I decrease my liabilities, debit notes payable with 110,000, and credit cash because I'm paying money on that date, July 14. From where did I get the 2,200, the interest expense? I just multiply the principal with the interest rate 12% and the fraction of the year, which is the amount of the loan or the note, 60 days over 360 the days of the year. Gives me 2,200, which is the number inserted here in the entry for debiting the interest expense. What about the 112,200? This is the loan along with the interest of the 60 days. This is the amount of cash I pay on the maturity date, which is the loan along with the interest of the duration of the note, which is here 60 days. Okay, moving to exercise 3, interest-bearing notes payable with year-end adjustments. By the word bearing, I mean that the note bears the interest on it, meaning that the interest rate is written on the note. Okay, exercise 3 states that Keisha Corporation borrows $200,000 cash on November 1st, 2017 by signing a 90-day 9% note with a face value of $200,000. A. On what date does this note mature? Meaning, what is the maturity date for this note? Actually, this note is issued on November 1st, 2017. And its duration will be 90 days. So the maturity date will be after 3 months from the issuance date, which is November 1st, meaning that the maturity date will be on November 1. I just add other 90 days, so the maturity date will be January 30, 2018. Okay. B. How much interest expense results from this note in 2017? And in C, how much interest expense results from this note in 2018? So we want to calculate here the interest in 2017 as well as in 2018, assuming of course that there are 360 days in a year. Okay, in order to calculate the interest, there is a famous equation that we know for calculating the interest, which is interest expense equal the face value, which is the amount of the loan, times the interest rate which is for sure stated in percentage, and by default it will be annual interest rate. Okay, times the fraction of the year. By the fraction of the year, I mean the duration of the note. So here, for example, it's 90 days, which means that I'm going to say 90 over 360, which are the days of the year. Okay, let's see how will we calculate the interest expense in 2017 as well as in 2018. We will use this equation, which is interest expense equal face value or the principal, the amount of the note, times interest rate times the fraction of the duration of the note. Okay. In 2017, remember that the issuance date is on November 1st, 2017, which means that the note will last in 2017 for just 2 months, November and December. So in order to calculate the interest, we'll just say principal, which is the face value, $200,000, times the interest rate, which is 9%, times the fraction of the year, which is 60 days, so 60 over 360, the 2 months, which are November and December, from November 1st to December 31st. So the total interest will be $3,000. This is in 2017. What about in 2018? If you remember, the note will mature at Jan 30, 2018, which means that the note will last in 2018 for just 1 month, 30 days. So in order to calculate the interest in 2018, we'll just say principal, which is $200,000, times the interest rate 9%, times fraction of the year, which is 30 days, January, the month of January in 2018, over 360, which are the days of the year. It will give us the total interest in 2018, which is $1,500. Okay. These are the answers for requirements B and C. Then Z, prepare journal interest to record the issuance of the note, accrual of interest at the end of 2017, payment of the note at maturity, assume no reversing interest earned. So you want to make here 3 entries. 1 entry for the issuance of the note on the borrowing date, and 1 entry for the accrual of interest at the end of 2017, because 2017 will end. However, the duration for the note will not end at the end of 2017. It will end at January 30, 2018, which means that by the end of 2017 I need to make an adjusting entry for the accrual of the interest expense. I already got benefit from the loan and, for example, used it in a project or whatsoever, so I need to debit the interest expense because I've just got the benefit, the accrued expense. This is an accrued expense, I got the benefit. However, I will not pay it now. I'll pay it on the maturity date, which is not yet which is not yet its date. It will be on January 30, 2018. So I need to make an adjusting entry for the accrued interest expense at the end of 2017. Then I will make an entry for the payment of the note at the maturity. On the maturity date, we will pay the principal, the face amount, along with the interest of the 90 days, the whole 90 days. Let's start with the entry for the issuance of the note on the date I borrow the loan. I will just say debit cash 200,000, credit notes payable 200,000. This is on November 1st, 2017, on the issuance date for the note. Then I want to make an entry for the accrued interest expense at the end of 2017. The adjusting entry for any accrued expense, as you know from the previous semester, so I just debit the expense and I credit the payable. So here it's debit interest expense, credit interest payable. From where did I get this 3,000, this number? I just multiplied the principal, which is 200,000, times the 9% times the fraction of the year, which is here 60 over 360 because month is November and December at the end of 2017. It will give us 3,000. Moving to the last entry you want to record, which is on the maturity date. On the maturity date, as we agreed with each other, I paid the amount of the principal, all, which is a 200,000, along with the interest of the 90 days, which means that this 3,000 along with the 1,500, the interest of the 1 month in 2018. So the entry will be as follows. I first debit the interest expense for the month of January in 2018 because I have not recorded yet. I just recorded the interest expense for the last 2 months in 2017, which are the first 2 months for the note. However, I did not record the interest expense for the last month of the note, which is the first month of 2018, January. So I just debit the interest expense for the 1,500, the month of January in 2018, and I debit the interest payable of 3,000 that we already recorded in the previous entry, since I'm now paying the interest. I not have any obligation regarding the interest now. I'm paying the interest. So debit interest payable, and debit of course notes payable to 100,000 because I'm paying now the amount of the note plus the amount for interest for the 90 days. So credit cash with 204,500. What is this 204,500? It is the loan along with the interest of the 90 days. The 3,000 of the 2 months and the 1,500 for the 1 month in 7 days. Okay. Okay. Let's solve another exercise on the notes payable. October 1st, 2018, Woods Company purchased equipment at a cost of $10,000, signing a 9 months 8% note payable for that amount. Record October 1st purchase. Okay, I've just purchased an equipment, but by not paying cash, but signing a note instead. So I have liability, which is called notes payable. So the entry will be debit equipment is 10,000 and credit notes payable is 10,000. Since I purchased the equipment in exchange for 9 months 8%. B, record the adjusting entry needed on December 31st, 2017, and payment of the note plus maturity on July 1st, 2009. Okay, let's start with the entry for December 31st, 2018. Actually, in 2018, I just got benefit from the loan I took for just 3 months, October, November, and December, since I took this note on October 1st. So at the end of 2018, I just got benefit from the loan I took for only 3 months. That's why I need to record the accrued interest expense for 2018. So the entry will be debit interest expense, credit interest paid. How much? Is 200. Just multiply the 10,000, the note, times the 8%, the interest rate, times 3 months over 12, the months of the year. Since I want to calculate only the interest for the 3 months of 2018, the last 3 months of 2018. What about the other entry needed to be recorded for July 1st, 2019? The maturity date. Actually, on July 1st, the maturity date, I'm going to pay the full amount of the note along with the interest that I have not paid yet. The interest for the whole note paid on the whole note. So the entry will be debit notes payable is 10,000. I decrease my liability because I'm paying it now. This is the amount of the loan, so debit notes payable is 10,000. And I already calculated the interest expense for the last 3 months of 2018. How about the first 6 months of 2019? since the maturity date for the note is July 1st, 2019, which means that the note will remain with me in 2019 for 6 months, from January to July. So I want to calculate the interest expense for this 6 months not yet calculated. So I just multiply the 10,000 times the 8% times 6 months over 12. This will give us 400. So I'm going to debit interest expense with the 400 to record the interest expense for the 6 months of 2019. Then I want to increase my liability that I previously recorded in December 31st, 2015 regarding the interest. I was just crediting interest payable with 200. Now I'm paying this interest payable, so I debit the interest payable with 200. And then credit cash since I'm paying the note along with the interest. How much I'm paying? The amount of the note, which is the 10,000, along with the full amount of the interest for the whole 9 months, which is 600. So I'm paying 10,600. I credit cash with the amount I paid, which is 10,600 on the maturity date. I paid this amount on the maturity date. Okay, let's solve exercise 5, another exercise on the sales tax. A restaurant made cash sales of $4,000 subject to a 5% sales tax. Required first to record the sales and the related sales tax, and then to record the payment of the tax to the tax authority. Let's first make the first entry for recording the sales and related sales tax. So I just debit the cash and I credit sales revenue and I credit sales tax payable. I record my liability toward the tax authority for the tax. So I credit sales tax paid. By how much? Stated it's 5%, so I just multiply the 4,000 sales times the 5%, which gives us 200. So the cash I'm going to pay is going to be the 4,000, the revenue, along with the 200 sales tax. Second entry to record the payment of the tax to the tax authority, I just decrease my liability. I'm paying cash, so debit sales tax paid and credit cash with the 200. So this is the cash payment for sales tax paid, and that's it. Okay. Let's move here to another topic or another issue, which is concerned about the contingent liability. What is the contingent liability? It's a liability or a potential loss that may occur in the future depending on the outcome of a specific event in the future. So it may or may not incur loss. Examples such as potential lawsuits if someone sues the company or something like that. So this may or may not incur loss in the future. This is called the contingent liability. Okay. Answer the following. How does a contingent liability differ from a known liability? When would a contingent liability be normalized? Actually, a contingent liability is a potential rather than an actual liability because it depends on a future event. Some event must happen, the contingency, for a contingent liability to have to be paid. Contingent liabilities are generalized when the likelihood of an actual loss is probable and the amount of expense can be reasonably estimated. So again, as I said, the contingent liability is potential. It's not determined. It's not an actual liability. It depends on the future event. So it may or may not incur loss in the future. And contingent liabilities are generalized. I make a journal entry for contingent liability when the possibility of an actual loss is probable, when there's a probability for an actual loss, and when the amount of expense can be reasonably estimated. When it can be reasonably estimated, the amount of expense. Okay, let's see how could I record or I treat the contingent liability from the accounting perspective. Okay, In this exercise, it's required to prepare any necessary adjustment entries by December 31st, 2017 for Melbourne Company's year-end financial statements for each of the following separate transactions and events. Number 1. Melbourne Company guarantees the $100,000 debt of a supplier. It's not probable that the supplier will default on the. Okay. Number 2, a dissatisfied employee is using Melbourne Company. Legal advisors believe the company will probably need to pay damages, but the amount cannot Let's start with requirement number 1. Melbourne Company guarantees the $100,000 of the debt of a supplier. It's not probable that the supplier will default on the debt. What is the necessary adjustment entries here? Actually, no adjustment entry is required. Since it's stated that it's not probable the supplier will pay or not repay the debt. So the guarantor, which is the Melbourne Company, should describe the guarantee only in the financial statements. Should add a footnote or something, should disclose this in financial statements. Should state that this is a contingent liability. Okay. Moving to number 2 in this exercise, a dissatisfied employee is suing Melbourne Company. Legal advisors believe that the company will probably need to pay damages, but the amount cannot be reasonably estimated. So here it is a contingent liability, and it's not it cannot be estimated. So if the contingent liability cannot be estimated, no entry is required. However, just a footnote. It needs to be just disclosed in the financial statement. So I just say no adjusting entry can be made since the loss cannot be reasonably estimated. Disclosure of the suit as a contingent liability should be made in the notes of the financial statement. So a contingent liability is recorded when it can be estimated. Else it should be disclosed, just disclosed. Again, the contingent liability, if it's estimated, I can record it. However, if it's not, I just disclose this. I make a footnote in my financial statement stating that this is a contingent liability that cannot be estimated. Okay, that's it for our tutorial 8. Hope it was beneficial for you. Thank you. Okay, moving to exercise 7. Here in this exercise, some different transactions happened in 2010 and 2011 for Titus Corporation. Let's start with 2010. On April 20th, Titus purchased $38,500 merchandise on credit from Fair. Terms are 1/10 and/30. Titus uses the perpetual inventory system. Then on May 19th, the company replaced the April 20 accounts payable to Ferrar with a 90-day $30,000 note bearing 9% interest, along with paying $8,500 in cash. This means that the company, instead of the accounts payable that was recorded for April 20's purchase, it replaced it with notes payable, a 90-day note, its duration 90 days, with interest rate 9%, along with paying cash $8,500 beside the note, instead of the accounts payable recorded on April 20. Okay, then moving to July 8th, what happened on July 8th? The company borrowed $60,000 cash from Community Bank by signing a 120-day 10% interest-bearing note with a face value of $60,000. So the company here took a loan from the bank. Its duration 120 days with interest rate 10%, and the face value the loan is $60,000, its amount. Okay, then the following, the company paid the amount due on the note to Ferrar at the maturity date. the money that the corporation owned for Ferrari when it purchased from Ferrari the merchandise on April 20th. It's paying it now on the maturity date. This question mark, because we need to specify or identify, we need to do this, the maturity date. We need to identify the maturity date. It's required from us to identify the maturity date. That's why the date is not written here and instead a question mark. The following transaction paid the amount due on note to community bank and the maturity date the same. It's required from us also to identify the maturity date. That's why there is a question mark beside this transaction to identify the maturity date for this note, the note we took from the community bank or the corporation took from the community bank. Then on November 20th, the company borrowed $21,000 cash from UMB Bank by signing a 60-day 8% interest-bearing note with a face value of $21,000. This means that the company took a loan with $21,000 from the bank by signing a note that's duration 60 days and with interest rate 8%. Then finally in 2010, on December 31st, the company recorded an adjusting entry for accrued interest on the note to UMB Bank. Of course, we know the accrued interest, the accrued expense, which we record for it an adjusting entry that is debit the expense and credit the payable. So debit interest expense, credit interest payable. Okay. Then in 2011, what happened in 2011? The company paid the amount due on the note to UMB Bank at the maturity date. And also there is a question mark before this transaction because it's required from us to identify the maturity date for this note that we took, or that the company took from UMB Bank. Okay, let's see the requirements that we need to answer for this exercise. Okay, the first requirement for this exercise 7, is to determine the maturity date for each of the 3 notes described. If you remember, we are having a note for Ferrari Corporation, from which we purchased from them the inventory on April 20th. Since we replaced afterwards the accounts payable with the notes payable, with the note duration was 90 days. Then we took a loan from the community bank, followed by another loan from UMB Bank. So we'll find here for the first note for Ferrari, the date of the note was May 19th, term of the note were 90 days, so the maturity date was August 17th. Then for the community bank, the loan we took from the community bank, the date of the note was July 8th, duration 120 days, so the maturity date will be November 5th. The note we took from the UMB Bank, it was taken on November 28th. Its duration 60 days, the term of the note. So the maturity date will be January 27th. These are the 3 notes described here. Moving to requirement number 2, determine the interest due at maturity for each of the 3 notes. Assume a 360-day period. Okay, starting with the first note, the principal of the note was $30,000. The annual interest rate 9%, and its duration was 90 days. So the fraction of the year will be 90 over 360 days of the year. As it said, assume that there are 360 days in the year. So the interest expense will be 675. As we know, the equation for calculating the interest expense, I just multiply the principal of the note times the annual interest rate times the fraction of the year. So this is for the first note that is from Ferrari. Then the following note, that the loan that we took from the community bank, the principal of the note was $60,000, annual interest rate 10%, and its duration 120, so the fraction of the year 120 over 360, which gives us $2,000, the interest expense. The last one, the note or the loan we took from the UMB Bank, the principal of the note was $21,000, the interest rate 8%, and the fraction of the year 60 over 360. This gives us $280, the interest expense. These are the calculation of the interest expense for the 3 notes. Okay, moving to requirement number 3, determine the interest expense to be recorded in adjusting entry at the end of 2010. If you remember that on December 31st, 2010, we need to record an adjusting entry for the accrued interest expense for the note taken from the UMB Bank. If you remember, the note of the UMB Bank was taken on November 28th, and its duration, the term of the note, is 60 days. So it will end, the maturity date will be, as we said a few minutes ago, the maturity date is on January 27th, 2011. So at the end of 2010, on December 31st, we need to record an adjusting entry for the accrued interest expense for this note. For how many days? Actually, it was taken on November 28th, and we assume, according to our book, it's assumed that any month is 30 days. As I told you before, unless others is stated in the problem. I mean, unless we stated for you in the problem that this month is, for example, 28 days if it's February or something like that. Otherwise, we'll assume, according to our book, that all the months are 30 days. So here, the note of UMB Bank was taken on November 28th, which means that in 2010, the note will last for 33 days in 2010. The last 3 days in November, 28th, 29th, 30th, plus the 30 days of December. So it will last in 2010 for 33 days. Accordingly, when I need to calculate the interest expense, I will just multiply the total interest for the note that we calculated in the previous slide, which is $280, times the fraction of the term in 2010, which are 33 days over 60 days of the term of the note, which gives us accrued interest expense of $154. So again, regarding this note, it's taken on November 28th, and it ends, the maturity date is on January 27th, 2011, which means that in 2010, at the end of 2010, we need to record an adjusting entry for the accrued interest expense. For how many days? For 33 days, the last 3 days in November, assuming that the month is 30 days, so it was taken on 28th, that means 28th, 29th, and 30th, 3 days in November, plus the 30 days in December, which means 33 days. So when calculating the interest, I just multiply the total interest that we calculated previously to $80 times the fraction of the term in 2010, which are 33 days over the 60 days, the term of the note, which gives us $154 accrued interest expense. And this number, we are going to use it when we are going to record the adjusting entry for the accrued interest expense. Okay, moving to requirement number 4, determine the interest expense to be recorded in 2011. As I told you that in 2011, the note of UMB Bank will last for just 27 days, since the note matures on January 27th of 2011. So we need to calculate the interest expense for these 27 days. How? As we just said in the previous slide, I'm going to multiply the total interest for the note previously calculated, which is $280, times the fraction of the term in 2011, which are the 27 days over 60 days, the term of the whole note of UMB Bank, which will give us the total expense in 2011, $126. Okay, now requirement number 5, it's required to prepare journal entries for all the preceding transactions and events for years 2010 2011. Let's take it transaction by transaction. In 2010, the first transaction was that we purchased on April 20th $38,500 merchandise on credit from Fair. Terms are 1/10 N/30. Titus uses the perpetual inventory system. Okay, as I told you in the previous semester, that these credit terms is an indication that we purchased the merchandise on credit, even if it's not said that we purchased it on a credit. Once we see this credit term, so automatically I know that this merchandise are purchased on credit. What does this credit term mean? Mean that if I'm going to pay the $38,500 within 10 days, I will take 1% discount. Else, I will the net amount is going to be paid until the 30th day, which is the grace period, as we previously said in the last semester. Okay, let's focus on the entry we need to record here for this transaction. I just purchased merchandise on credit. Merchandise is the merchandise inventory, it's an asset. So I'm going to debit the merchandise inventory and not credit cash because I haven't paid cash. I've taken them on credit. So credit accounts payable, as we can see here. Okay. Moving to the following transaction on May 19th, we placed the April 20 accounts payable to Ferrar with a 90-day $30,000 note bearing 9% annual interest along with paying $8,500 in cash. As I told you, that here means that I'm just replacing the accounts payable with the notes payable and cash. As if I purchased the merchandise with just signing a note with duration 90 days with an interest rate 9%, along with cash of $8,500. So I need to decrease the accounts payable because it's no longer now accounts payable. And as I previously told you, the difference between the accounts payable and the notes payable, that the accounts payable, it's a verbal promise. However, the notes payable, it's written promise. I sign on a note. And of course, I pay interest. There is interest accompanied with the note. However, the accounts payable, no. So these are the two main differences between the notes payable and the accounts payable. The notes payable is signed, it's written promise. However, the accounts payable just verbal. And there is interest paid along the note. However, the accounts payable, no interest is paid. Okay, let's see the entry. As I said, I need to decrease the accounts payable, so it's going to be debit accounts payable. And I paid cash, so credit cash. And there's a liability, which is the notes payable instead of the accounts payable. So it's going to be credit notes payable. And that's it. Okay, on July 8th, the corporation or the company borrowed $60,000 cash from Community Bank by signing a 120-day 10% interest-bearing note with a face value of $60,000. So here, a loan is taken of $60,000 from this bank, and the duration of the loan or the note is 120 days, and there is bearing interest note 10%. And the face value is $60,000. So I took cash, therefore I'm going to debit the cash, my cash increased, and I record liability toward this bank, which is the notes payable. The liability is the notes payable. So debit cash and credit notes payable with $60,000. Then moving to the following transaction, paid the amount due on the note to Ferrar at the maturity date. Here I'm paying the amount I owed to this company when purchasing merchandise by signing a note. As you can see here, to determine the maturity date, which we already determined previously when it was required from us to determine the maturity date for each note. So here the maturity date will be August 17th as we previously determined. On the maturity date here, I'm paying the amount of the note along with the interest expense. So I need to record the interest expense, and I need to decrease my liability since I'm paying it, so debit the notes payable, and I'm paying cash, so my cash is decreased. Therefore, I credit the cash. As you can see here on August 17th, debit interest expense by how much? 675, as we previously calculated in the previous slides, when we just multiply the principal of the note, $30,000, as you can see here, times the annual interest rate, 9%, times the fraction of the year, since the duration of the note is 90 days, so 90 days over the 360 days of the year. As it's stated in the problem, assume that the days of the year are 360 days. Gives the other interest expense of $675. Okay, and then I debit the notes payable with the 30,000, the amount of the note or the loan. Then I credit cash with the whole amount I paid, which is the amount of the note along with the interest. So the 30,000 plus the 675. So on the maturity date, I'm paying the amount of the note along with the interest expense for the whole duration of the note. And as I stated, that the maturity date is August 17th, since the note was taken on May 19th, and it's for 90 days. The term of the note is for 90 days. So the maturity date will be August 17th as it's written here in the entry. Okay. Okay, here pay the amount due on the note to community bank at the maturity date. The same, I need to pay the note so that my cash decrease and my liability decrease, the notes payable decrease, and I need to record the interest expense related to this note. So I'm going to say debit interest expense, debit notes payable, credit cash. On the maturity date, I'm paying the amount of the note along with the interest expense. So I'm paying the 60,000 amount of the note along with the interest expense, which is 2,000 that we already calculated in previous slides when it was required from us to calculate the interest related to each note. How about this question mark? Also, I need to identify the maturity date, and we already identified it when it was required from us in requirement number 1, I think, to determine the maturity date for each note. So here the maturity. Okay. Then the following transaction: borrowed $21,000 cash from UMB Bank by signing a 60-day 8% interest-bearing note with a face value of $21,000. I've taken a loan from UMB Bank. Its face value is $21,000, and the term of the note is 60 days. Will last for 60 days, and there's interest related to this note. The interest rate is 8%. So my entry will be as follows: debit cash and credit notes payable with $21,000. Moving to the transaction December 31st, in which it's required from us to record an adjusting entry for accrued interest on the note to EMB Bank. As we know that the adjusting entry for any accrued expense goes debit the expense and credit payable. So here it's interest, so debit interest expense and credit interest payable with the 154 we already calculated previously. For the 33 days that this note will last for in 2010, since this note was taken on November 28th. So the last 3 days in November plus the 30 days of December makes 33 days. I will remind you again that according to our book, we assume that the month is 30 days. That's why we say here that we want to calculate interest for just 33 days, which will give us 154 as we previously calculated. Finally, in 2011, the transaction was paid the amount due on the note to UMB Bank at the maturity date. The maturity date for UMB Bank, which is January 27. I'm just paying the amount of the note with the loan, and I'm paying, so my cash is decreased. My notes payable is decreased with the amount of the note. So debit notes payable is 21,000 and credit cash with the 21,000 along with the amount of interest of the whole period, which is 280. From where did we get this 280? Let's see here. I record the interest expense for the 27 days in 2011. What are the 27 days? And this note was taken on November 28th, and the maturity date is on January 27th, 2011. So in 2011, there are 27 days on which the note will last. So the debit interest expense was 126. 126 is the interest for these 27 days. However, the interest for the first 33 days, that was in 2010, the last 33 days in 2010, it was already calculated of 154, so I just decreased the interest payable since I already recorded the interest and I was recording my liability towards paying this interest on the maturity date. So I'm just decreasing this liability. So I debit the interest payable with 154. And I record the interest expense for the 27 days in 2011. So I debit interest expense with 126. And I debit the notes payable with the amount of the note, which is 21,000. Then I credit cash with the amount I'm actually paying on the maturity date, which is January 27th, the maturity date, as we already determined the maturity date when we determined the maturity date for each note, as I previously said. So it's the January 27th, and the note was taken on November 28th, and it lasts for 60 days. Okay. So credit cash with the 21,000 plus the 280, the interest for the whole 60 days. Here, that the 126 is the interest of the 27 days in 2011. However, the 154 is the interest of the last 33 days in 2010. Okay, so this 280 is the whole interest. The whole interest. The 126 plus the 154, which gives us the 280. Okay, thank you. That's it for our tutorial 8. Hope it was beneficial for you. Thank you.